Hey folks, this is Shawn over at the Annuity Expert. In today's video, we're going to go over some common questions about the annuity basics to give you a better idea of what you're getting into when looking and researching and potentially buying an annuity. So, straight to the point. What is an annuity? Annuity is a contract with an insurance company where you deposit money and in exchange you receive a tax-deferred growth and or income payments. And it's used for protection, income, or a combination of both. The main reason why people buy annuities, stripped down from everything, is just to get that contractually guaranteed income for life. So what that means is you take your retirement account or cash and you buy an annuity for lifetime income. What you're guaranteeing is, like, after your retirement savings have been depleted, the insurance company has to contractually guarantee you that same or better income for the rest of your life. It's sleep at night insurance, but it really is it's an automated money manager. Okay, so think of it this way. You've saved your retirement savings for 30, 40 years of your career. You're going into retirement. You don't know how to spend this retirement account. You don't know how to protect it. You don't know how to invest it. And basically what you want to do is grow it, and you want to be able to get a paycheck. And there's a couple of ways that you can go about that. One, you can go off into a big box financial advisory firm that you see all over the place. And you can have a person manage your money in the market. And what they're going to do is distribute your income and charge you a hefty fee each and every year. And that money manager's role has to make sure that your accounts stay balanced or better, and also distribute you an income and keep up with inflation. That's one way to do it. Another way to do it is utilizing an annuity. And what the annuity will do in most cases will allow you to automate the income distribution. So you get the same paycheck or better for the rest of your life each and every month as if you were still working. And while it's distributing income, it's growing tax deferred, and it is growing based on several ways, whether that's a fixed interest account or if that's earning interest based on the performance of a stock market index like the S&P 500 or the NASDAQ or the Dow Jones. Or you can be in the market itself using a variable annuity. And what it will ultimately do is it will automate everything that you need in retirement. And in most cases, you're not going to have to worry about losing money to a stock market crash. Okay, so if you're a person that is tired of the volatility, don't want to worry about losing money, and wants to make sure that they're going to get a paycheck to maintain your lifestyle to the day that you die, the annuity is a perfect fit. What an annuity is not a perfect fit for is the person who wants to be in the stock market, likes the adrenaline of the ups and downs of the market, doesn't mind about continuing to invest. Even though I think, in my professional opinion, that everybody should have a foundational income plan. Usually that's Social Security, and that's in layering an annuity lifetime income on top of that Social Security to pay you. And then after your lifestyle, after the foundation of your lifestyle is complete, do whatever you want with the rest of the money. At least you have something, some say a safety net to fall back on in case something does go awry in the market. Okay. So what are some other things that annuities solve? Well, an annuity can help pay for long-term care. Long-term care is one of it's the retirement killer. If you get dementia or Alzheimer's or Parkinson's, you're going to need to go into a nursing home or assisted living or home health care. And at that point, it is too late to get any sort of long-term care insurance. And the U.S. government is saying that 70% of retirees over the age of 65 is going to need home health care, assisted living, or nursing home at some point in their life. So 7 out of 10 retirees are going to need that. And most don't even think about it, or they wait too late. In the example of dementia or Parkinson's or Alzheimer's, once you get that, you can't get any sort of insurance to cover you because you've already have that pre-existing medical condition. Another way annuities, problems that they solve, inflation. Most annuities have several different types of payout options. When we could talk about that, one of them is the increasing income option. And what that does is it gives you a slightly less payout up front, and the income will increase and never decrease from that point, almost annually to keep up with inflation and maintain your lifestyle for the next 20 plus years in retirement. Another problem that annuities solve is life insurance alternative. If you can't get life insurance, or if you're in the case of that you've gotten a medical condition such as cancer, or in the case of Parkinson's, Alzheimer's, dementia, you can move your retirement accounts over to an annuity with an enhanced death benefit that will go down to your beneficiaries and beef up that retirement account almost instantly, so that they're taken care of at the time of your death. For example, there are certain annuities out there that will give you up to a 50% bonus day one on your retirement accounts that can be utilized as a death benefit for your beneficiaries. And they'll be able to, instantly get a 50% increase on whatever their accounts are worth without any sort of medical underwriting. What other things? Annuities allow you to earn interest based on a stock market index. So if you're in a place where you don't quite want the fixed interest rate like a CD, which you'd get in a MYGA, you could go and get a fixed index annuity, and that fixed index annuity allows you to earn interest. Well, it gives you a choice. You either earn interest by a declared fixed rate that you get each and every year, and it changes each and every year, or you can earn interest based on the S&P 500 or the NASDAQ or the Dow Jones. And no, you're not in the market. The insurance company uses those index as a measuring stick to determine how much or how little interest you earn each and every year, with 100% downside protection. So that's another option. Another option would be a variable annuity. That's where you're typically using mutual funds and different investments, and you are actually in the market, and you can lose money as an option as well. Another problem that annuities solve is offsetting losses. Some annuity contracts have premium bonuses, and this is money that the insurance company guarantees. And so if you're going through a loss from stock market volatility, or you're in an annuity contract that isn't performing the way that you want it, and you want to exchange it, you could roll it over into an annuity with a bonus, and that bonus will help offset those losses and put you either where you were prior to the loss or put you ahead. Some other questions that they typically get when it comes to annuity basics is, well, how do you get an annuity? Well, you got to get an annuity through, in 98% of the time, you have to get it through either an independent insurance agent, an annuity broker, financial advisor. The best places to get it is an independent annuity broker, because they have the largest selections of annuity contracts in the United States, the Annuity Expert being one of them. We have the largest annuity contract availability in the United States. So you typically have to go through an insurance agent or a annuity broker or financial advisor. Where can you get an annuity? Once again, going through licensed agents, brokers, agencies. How do you find the right annuity? Well, you utilize the agent, the broker, or a financial advisor. Really, it is coming down to comparing multiple companies, comparing the contract terms, the income payments, not just the rates. And a broker like the Annuity Expert does that for you. And the way we work is we reverse engineer everything. We work our way backwards. So if it's income you want, we look for the highest income with the best rated company. And then we kind of look at the bells and whistles and the contract terms. And we give you a couple of options. And from there, you pick out what you want. Another question, how much does an annuity cost? The minimum is $10,000 in a lot of cases, but the better annuities typically start at $20,000. And you can go up to several $1 million. Once you get to the $1 million mark, you have to do what's called a large case approval process. And you fill out like a 2-page form that you have to submit to the insurance company ahead of applying for that annuity. And as long as the insurance company deems you suitable to buy an annuity of that size, you can buy it. Next question, how much annuity income will I get? Well, it depends on your age, the deposit amount, and the annuity type. Older buyers older buyers and higher deposits generate a higher income. So there's no universal payout. If there's one key item to know when it comes to getting a higher income is, besides age and the deposit amount, is the length of time between the annuity start date, so the day that you buy the annuity, and the start date of the income. So the longer you defer prior to taking your lifetime income, the higher the payout will be, which can also be looked in a way of it becomes cheaper. So for example, if somebody who's 60 years old and buys an annuity and wants to start income at age 65, they're going to get a higher income than they would at age 60. However, if somebody who's in their 40s and they defer it to their 65 are going to get a much higher payout than they would from a 60-year-old to getting it at 65. Or they can have the same payout, but it will cost them a fraction of the cost. Another question, is there a 7% annuity? No, that refers to a roll-up rate. And that's one thing, if you're watching this video and you're shopping annuities and you've already started that process, you're going to see a lot of bells and whistles, like for 50% bonus or 7% guaranteed every single year. Don't be distracted by that feature. That is a shiny object being floated in front of you so that you take the bait and you contact somebody. And reality is a lot of times those are fictitious numbers that other financial advisors or brokers or agents will put in front of you to get you to talk to them. And you're going to be, in most cases, poorly disappointed. So if you see any sort of it's too good to be true type of situation, it probably is too good to be true, which is why you should utilize an annuity broker when you're doing your annuity shopping. Next question that I get, when should you get an annuity? Well, like I said earlier in the video, the longer you can defer prior to taking that income, the higher that payout will be. So if you can get it before retirement and let it sit, the longer the process is, you usually can get a lifetime income rider starting at age 40. I'm not saying getting an annuity at age 40 is the right thing to do, but we've seen folks get $100,000 a year contractually guaranteed starting at age 65, and they bought the annuity at age 42, 43 years old, and it only cost them like $400,000. And that varies based on product and interest rate environment. But just to kind of give you an example of what we've seen in the past, that time frame between 42, 43 to age 65, it's a long time. And the longer you wait, the higher the payout. And the cool thing is about annuities, that nothing else can do in the United States for you in terms of guarantees, is that all the guarantees, when you use a lifetime income rider on an annuity, it's all predetermined. It's all mathematically calculated up front, and the insurance company has to abide by those contract terms. So you could know up to 30 plus years in the future what your income is going to be today, which most people don't realize. You can also get it near or in retirement. You're going to get a higher payout than you would in most cases with having a financial advisor manage your money in retirement. Typically, they give you a 4% payout, and then adjust for inflation. With annuities, it'll range anywhere from 6 to 9, 10% payout for the rest of your life. What other questions? What can you do with an annuity? Well, you can let it grow. We went over that before. You can earn a fixed interest rate using what's called a MYGA, which stands for a multi-year guaranteed annuity. Works almost like a CD. You get a pre-fixed interest rate for a set term. After that term, you take your money and you can run. The MYGAs, in my opinion, and it's biased, are better than CDs, frankly, because you have the liquidity in a lot of cases. You get a higher interest rate. It triple compounds because it's tax deferred. And then when the term's up, you can move it and do with what you like. Going over the fixed index annuities, you can earn a fixed interest rate or a stock market index without being in the market, or a combination of both. And the variable annuity, turn on lifetime income. You can take withdrawals. You can pass it down to beneficiaries and avoid probate in most states. And you can use riders for long-term care or enhanced death benefits. How do you take money out of an annuity? Well, there's several ways you can do that. First off, there's several types of annuities out there, and they've evolved over time. Most annuities, you're allowed to have some sort of liquidity, whether that's through a penalty-free withdrawal. Some offer a return of premium, meaning if you decide that you change your mind in the contract, you can get your original investment back minus fees and withdrawals that you've taken. There's accumulating penalty-free withdrawals. And the analogy I use is, think about old school cell phone minutes where, hey, I didn't use my penalty-free withdrawal this year and it rolls over to the next year. You can do lifetime withdrawals using a lifetime income rider. And then there are these other annuities called the original annuities through immediate annuities or through deferred income annuities called DIAs or QLACs. You annuitize it. And what that means is you hand over control over your money to the insurance company, and in exchange, they give you what's called an irrevocable, focus on that word, irrevocable stream of income for either a fixed period or for the rest of your life. We don't typically recommend that in most cases. We're not fans of people losing control over their money. And a lot of times the lifetime income riders pay a higher payout and give you control. But yeah, so let's kind of go dive into that because I don't think at this point in the video we've really talked about it. So when you're doing annuity payments or lifetime withdrawals, there is a huge difference. So when you want lifetime income, you have two options. Option one, this is going back to the original the first question in this video. What is an annuity? Annuity is a legal contract between you and an insurance company. So if you want lifetime income, which is why most people buy an annuity, you have two options. Option one is the OG way of taking income, and that's annuitization. And annuitization is that irrevocable stream of income. You lose control over your money. The insurance company, in exchange, gives you this irrevocable stream of annuity payments for a fixed period of time. So 10 years, 15 years, 20 years, and then it ends, or for the rest of your life, or the rest of your life and your spouse's life. So 2 lifetimes for the price of one. Once you do that, there's no changing your mind. It's locked in and you're getting that payout. Okay. The other way is you buy a deferred annuity. So that's your MYGA, your fixed index annuity, your variable annuity. And you add a bell and whistle called a lifetime income rider. There's different terms for every different products. The most common is called a guaranteed lifetime withdrawal benefit. But in the industry, we just call them guaranteed lifetime income riders. And you add it on to it's an upsell, and you add it onto your contract, and you typically pay a fee for that. And that fee is usually around 1 to 1.25%. And it is deducted from your account each and every year. And what you get in exchange is you get this contractually guaranteed income for the rest of your life, or the rest of you and your spouse's life. The income is fixed, or it'll increase. And there's some options where you can get more income up front and it'll decrease in the future. So that's kind of a niche type of client of ours. But you get this contractually guaranteed income. And if you decide that you change your mind in the future, you're able to cancel that contract. Yes, you'll probably pay a surrender charge, but you have the choice. Okay. You also get to earn interest by going that route. So while you're taking income or deferring prior to taking income, you're growing that contract over time. You also get a lump sum death benefit. It goes down to your beneficiaries. If you have a spouse and you've chosen not to have the joint life payout, you have spousal continuation, which is a provision in almost every annuity where your spouse can pick up the contract as if you were still alive at the time of your death and keep deferring those taxes, or at least until RMD time if you're using qualified accounts. So yeah, those are the two different ways. 90% of the time we are recommending getting a deferred annuity and adding a lifetime income rider. Yes, you pay a fee, but you get what you pay for. Or you can do annuitization, your choice. Okay, next question. Can you get out of an annuity? Yeah, you can get out of an annuity. You can surrender the contract, just like any sort of other contract that you have, whether it's a lease or whether it's with a car, with an apartment. There's some ways to reduce those surrender charges. Our recommendation is to take out a 10% penalty-free withdrawal this year, wait to the anniversary date, take another 10% penalty-free withdrawal out of that. The surrender charge should lower by that second year, then surrender it. Okay, so if you can give yourself a little bit of time to take money out instead of all at once and paying the penalty on all of the money, maybe you pay a lower surrender charge on a lesser amount of money. Okay, and at the Annuity Expert, we can help you set up that as well. But usually you can get out of you can get out of an annuity, whether that's through a 10% penalty-free withdrawal, a lifetime withdrawal, or a lot of times these deferred annuities have health-related waivers. So nursing home waiver, most contracts have, hey, you go into a nursing home for 30, 60, 90 days in a row. They'll waive all surrender charges. You need long-term care, they'll waive surrender charges, disability, assisted living, if you're terminally ill. So there's some health-related opportunities there where if you need to get access to your annuity without the surrender charge, most insurance companies offer that. So going on to the next question. Okay. With annuities, which company should I go with? Well, that really depends on you. There's over 1,000 different annuity contracts in the United States. We typically recommending going with an A- or better insurance company that's with AM Best. I don't see a whole lot of reasons to go with a B-rated company. But yeah, I mean, there's plenty of options to fit your retirement needs. So there's really no reason to go with a B-rated company unless there's this interest rate that is higher than everybody else. But the gamble you take is you're taking it with a lower rated company. That company may go into insolvency. Let's see. Here's some other questions. What's the basic function of an annuity? Its primary function is to provide a steady contractual guaranteed income, often for life. How do annuities work for dummies? It's easy. Hey, you take your money, you grow it tax deferred, or you take an income for the rest of your life. Are annuities safe? Yes. Annuities are backed by insurance companies. They've been around since the Roman times, so way longer than a 401k or an IRA or a Roth IRA or any retirement account that you're dealing with. They are not FDIC insured, but they have some reassurance through the State Guarantee Association, which every state has. You could just Google your state Guarantee Association. So I'm in Georgia, so just go to Google and type in Georgia State Guarantee Association, and it'll pop up, and it'll have all the limits there for you. It's usually around $250,000 or more. What does an annuity protect against? Annuity at its core protects against outliving your income. What happens if I die with an annuity? If you got named, most annuities offer the option for a designated beneficiary, and it varies by annuity contract. The one annuity that you don't want to go with is, and this is through annuitization, not lifetime income, not lifetime income rider. If you annuitize and you see life only or joint and survivor, there's typically not a death benefit there. So I'll give you an example of that. You give the insurance company $100,000. You want to take income. You choose the life only through annuitization. You die, you get hit by a bus in 30 days. The insurance company keeps the rest of the money. That's going into a joint and survivor. Same thing. You and your spouse get into a car crash and you both die. No death benefit for your beneficiaries. Okay. That's like 2 scenarios out of like a dozen annuity scenarios that the insurance company is going to keep your death benefit. Most of the time, if you are married, your spouse can use spousal continuation at death and basically can pick up the contract, continue it as if you were still alive, and then he or she can make a decision what they want to do from that point on. And then if you're not a spouse, well, even if you are a spouse, if you're a spouse or a non-spouse beneficiary, you can opt for the lump sum death benefit, which is whatever's left in the account will go down to the beneficiaries. And most times it's in a lump sum. Next question, do annuities avoid probate? Yes, in most states they avoid probate. You just got to list a designated beneficiary on the policy. Do annuities have fees? Yeah, just like anything, most annuities have fees. With the MYGA, you typically don't see a fee. It's usually in the form of an interest rate reduction if you had some sort of bell and whistle. But most of the time, there's no fees. FIAs, DIAs, that's going back to the annuitization. There's little to no fees. And if there is some sort of fee, it's a reduction in your irrevocable payment amount. With fixed index annuities, yeah, you're going to pay fees for a bell and whistle that you want. So, for example, if you want higher upside potential, you have to pay for that. If you want a long-term care rider, you got to pay for that. If you want a lifetime income rider, you got to pay for that. If you want some sort of enhanced death benefit, you got to pay for that. Now, with that said, there are options with fixed index annuities that don't charge you a fee for a bell and whistle. Going through a broker will help you guide you through that, but just know you're going to give up something. You're going to give up something for not paying a fee for some sort of bell and whistle. So just know that. When you pay a fee for a financial advisor, for a fixed index annuity, you get what you pay for, okay? With variable annuities. Variable annuities are by far the most expensive type of annuity, where you're going to pay 1 to 1.25%. You're probably going to pay 3 to 4% in fees in your variable annuity, okay? Which leads into commissions. There are 2 types of sales with annuities, okay? And this is important. There are commission-based advisors or agents or brokers, and then there's fee-based fee-based advisors, agents, or brokers, okay? The Annuity Expert is commission-based annuity brokers. What that means is the insurance company, when they create the annuity contract, they have a predetermined commission that we earn at the sale of the annuity to you. It does not come out of your pocket, and it doesn't affect the annuity contract in any negative or positive way. Okay, it is what it is, but it doesn't come out of your pocket. And then it's our job to help you, guide you and manage that annuity contract going forward. All right. Second way is the fee-based way. This is kind of going back to the hiring a financial advisor. Whether it's a good market or a bad market, you're going to get charged a fee for managing that account. And that's typically in addition to any sort of bell and whistle fee that you're going to pay. My opinion, it's better to go to the commission-based route simply because it doesn't affect your annuity contract in any sort of negative or positive way. It's paid, it's coming from the insurance company, and you still end up having similar or better benefits than a fee-based annuity sale. The only way you can find that out is by contacting an annuity broker like the Annuity Expert. You're going to hear things or see things like, oh, hefty commissions from commission-based advisors, beware. That's a crock of garbage. When you look at over a 10-year period, a fee-based annuity sale or a fee-based financial advisor is going to be vastly more expensive, and it's going to be out of your pocket and in a good or a bad economy than getting a 5 to 7% commission that's paid from the insurance company, where your contract doesn't get affected negatively or positively. So those are the two ways. Are annuity payments taxable? Yeah, it's taxable. It's taxed as ordinary income, federal and state income taxes. No, there's a cost basis at death. Most retirement accounts follow those same rules as well. So if you have a 401k, it's no different. So there's no real advantage in terms of an argument of, well, if you invest, there's a step up in basis if you're using a 401k to fund the annuity. Okay, they're taxed in two different ways. Three different ways. There's the qualified accounts, that's 100% taxable. There's non-qualified accounts where you're paying with after-tax money and only the gains are taxed. And then there's the Roth payout where it's tax-free income. You're not taxed until you take the withdrawals or RMD time comes up. But yeah, you're going to pay your federal and your state income taxes. Okay. If your annuity runs out of money, do payments stop? Yeah, if you have an annuity and you don't add if you have a deferred annuity, and this is what this question refers to, and you withdraw money like a savings account, yeah, payments stop. But if you add a lifetime income rider, the income continues to keep paying you the same amount or higher depending on the contract, even if the account balance has run down to zero. Next question, what type of accounts can I use to fund an annuity? Man, you could use IRA, 401k, 403b, thrift savings plan. You could use 457b. You can use brokerage accounts. You can use CDs. You can use savings. You can cash. You can use the cash value of life insurance. You can fund it with just about anything that's available in the United States. Can I buy an annuity for my child? Yes, less common to do, but yeah, you can buy an annuity for your child. Can you cash in an annuity for a lump sum? Yes, but if you have a deferred annuity, yeah, you can, but you're going to pay a surrender charge. Why can't I withdraw money from my annuity? Probably because you annuitize the contract, and at that point, it's too late. Sorry. Let's see. Do annuities beat the 4% rule? 4% rule is this rule that most financial advisors have where when you're ready to retire and start collecting some of that retirement income, that retirement savings you've saved up all these years, they will give you 4% of what the account is and starting in year one, and then they will give you that and adjust for inflation each and every year after that. and their job is to maintain the contract by distributing you that 4% withdrawal rate. But you could do better with an annuity. Okay, can I use annuity income before retirement? Yes, if you use a non-qualified life-only SPIA, you'll typically avoid the IRS early withdrawal penalty. We recommend getting a life insurance policy for that investment amount, just in case you get hit by a bus and the insurance company keeps the money. Does it cost anything to ask questions about an annuity? No, just call into us, into a broker. Broker should give you a question at no charge. The commission is where we get paid, and it's a nice hefty commission. So we should be able to answer questions for free so that you find out whether it's a good fit or not. And that looks like all the questions that we have for this Annuity Basics page. If you have any questions, call us here at the Annuity Expert. Direct line is 770-755-1565. We're licensed in all 50 states. We give free advice, and our goal is to get you the best annuity product for your personal needs. And we'll tell you straight up if an annuity is a good fit or not. So once again, 770-755-1565. Hope this was informative. If there's any other questions, call in and we'll help you out. Thanks. Have a great day.